Delisting concerns for Alibaba's shares have hit feverish levels, and it's taken the share price of Alibaba down 16% in the past 5 days to levels that we haven't seen before. So is it time to pull the plug on Alibaba and just walk away? Well, based on the information that I'm seeing right now, I'm not so convinced. So let's dig into what's happening here. You're watching More Money, let's get it. So guys, I've been getting a lot of questions today about this from the Patreon family. As Alibaba share price is down to $112 a share approximately at around noon of when I'm recording this video, it seems to be frightening quite a few people. So it seems like a lot of people are getting nervous right now, and I really want to be here in these times to make sure that you guys have the best information possible so that you can make the right decision. So as we get into that, guys, please smash that like button and let's get into it. Overall, we're seeing reports that suggest that Chinese regulators will restrict Chinese companies' abilities to list overseas. Now, this comes after DIDI was asked to delist from US markets by China on data security fears, which of course raised the prospect that Alibaba and other groups may be forced to delist from US exchanges. So what exactly happened to reignite these fears of delisting for these Chinese names? Well, in order to understand this, you got to really get into the details. So hopefully I can do that for you now. On November 25th, Reuters reported that the Chinese and US authorities are working together to prevent delisting of Chinese companies from US stock markets. Shen Bing, the Director General of the Chinese Securities Regulatory Commission, stated the following: "We don't think that delisting of Chinese firms from the US market is a good thing either for the companies, for global investors, or Chinese-US relations. We are working very hard to resolve the auditing issue with US counterparts. The communication is currently smooth and open." So that's really, really good news. However, if that is the case, why are the shares then tanking? Well, it's because he went on to say the following: "There is a risk of delisting of these companies, but we are working very hard to prevent it from happening." So although that sounds like a minimal risk, it really is the first time that I've heard a Chinese regulator really admit to the possibility, even a small one, of a delisting. And that, combined with the DIDI situation, seems to have been enough to scare investors away. Now hold on to your hats, guys, because it actually gets worse. So on December 1st, literally 2 days ago, Bloomberg announced that China plans to ban tech companies using the VIE, variable interest entity structure, from raising capital in foreign markets. And those companies that have already been listed using this scheme will now need to make changes to their ownership structure to make it more transparent in regulatory reviews, especially in sectors off limits to foreign investment. So although this news is harmful, we have to understand that it's coming from unnamed sources, and the report even goes on to state that it's not clear if there's going to be a revamp to shareholders or more drastically a delisting of the most sensitive firms. And a Chinese securities watchdog has fired back, saying that all reports on China's possible bans on overseas listing through VIEs are not true. So it looks like the sell-off in the stock largely is fear-driven right now, as there is now for sure a greater than 0% chance that the stocks can be delisted. In my opinion, this is all FUD, fear, uncertainty, and doubt. But if you are an investor that rather not deal with Chinese government or regulatory issues, I completely understand just selling and walking away as a peace of mind. Now, what exactly happens if the stock does get delisted? If you hold a foreign stock and it gets delisted from a US exchange, you'll still own the stock. A stock's listing status has nothing, and let me repeat, has nothing to do with ownership rights. Your holdings are still valid. However, if the stock is delisted, you just lose the ability to trade the stock on US exchanges, i.e. the NYSE or the NASDAQ. In this scenario, you may still be able to trade the stock over the counter. Most brokerages allow over-the-counter trading, though not all stocks are supported. For example, Volkswagen is one that is traded over the counter, and it's likely that BABA will also be supported. Alternatively, as explained on the channel before, you can ask your brokerage to convert the shares into Hong Kong listed shares. Now, what all this means and what I'm really trying to say is that BABA's delisting is not the end to Westerners being able to trade BABA stock. If it is delisted, which is an extremely low probability in my mind, then you'll still be able to trade it over the counter or alternatively on Hong Kong exchanges. So is it still worth it to hold the stock? Well, ultimately, you're the best judge of that with your own financial situation. Personally, this does not have me concerned, but the regulator comment has piqued my interest to keeping a finger on the pulse of the situation, which of course I will relay to you guys because you guys trust me to provide you with the best information that I can possibly provide. It's honestly really hard to be a contrarian, especially in these moments. The best that you can do is do as thorough due diligence as you possibly can do, be properly diversified, and stick to your portfolio plan. Now, the main item that people are concerned with are the risks inherent with investing in China, and to alleviate some of your fears, I actually made a quick 2-minute video addressing them right here.